And I believe that we are live. So welcome to our first ever Hurst Cycles live Q&A. I enjoyed being live so much on Monday, I think it was, that I did this, that I decided I would do another live. Now, here I am. Hello, and I'm live. And hello to everybody. I've got some comments coming in already. Thanks very much. Hello, Maurizio, and hello to Robert. And I'm seeing other people coming in on Facebook as well. I'm not quite sure how to enable those comments on Facebook yet. I'm still learning this live streaming system. And there's another one. Hello, Riga. Okay, so let's get straight into it. The first thing that we need to do, of course, is make sure that you have read and understood these disclaimers, because, of course, the disclaimers are very important and they are legally obliged. So the story behind this Q&A is that our live stream on Monday was very well received. Many of you said, why didn't you let us know you were going live? Well, it was a bit of an impromptu decision, so I apologize for that. And it interestingly brought out a lot of questions. So let's get straight into the questions. The way that I'm planning to do this today is I like to keep these videos as short as possible. I know how important time is, so I'm not going to sit here and speak forever, I hope. And so I have organized, first of all, questions that have come in via email. And my plan is to, first of all, answer those questions. We have had a few questions that have come in the last few minutes, just before we went live. So I'm hoping to get to those. And of course, if you have questions, then do please post them in the chat window. I'm just show these quick chats from everybody saying hello. Lovely to see all of you. Thank you so much for joining me. And I'm just quickly showing you all. There we go. Okay, fantastic. Thank you. So let's first of all turn our attention to this first question. This was a fantastic question that we received shortly after the live stream on Monday. And the question has to do, I'm sure you can read it, so I'm not actually going to sit here and read it to you, which would be a little bit foolish. But the question is basically speaking about the S&P 500 and the fact that the second 18-month cycle went very bearish. And you can see they say in their question, would we have been flabbergasted when price turned down so soon? I think that's such a lovely phrase. So no, I think flabbergasted might be the wrong expression, but certainly the markets do often provide us with surprises. And I think perhaps that is a really important message. So let me answer that question very quickly and explain, first of all, what the question actually is. Here is the analysis that we've been looking at for a long time in the S&P 500. We have a 9-year cycle trough over here in, where is that, in March of 2020. And of course, we have the first 18-month cycle trough in this slightly strange position at the beginning of October 2021. So the person who sent us this question, I believe the name was Graham. I apologize if I get the name wrong, but the person who sent us this question pointed out that this first 18-month cycle is extremely bullish. There is the M shape for that 18-month cycle. Why do we know that it is so bullish? Well, first of all, it moved upwards a huge amount. That's a really simple and obvious way of determining that a particular cycle is bullish. And the other reason why we know that the cycle was bullish is, as the person who asked the question mentioned in their question, the peak occurred very late. When a peak occurs late and the ending trough of the cycle is a lot higher than the opening trough of the cycle, we have a very bullish cycle. This is an extremely bullish cycle. The question then moves on to say that the next 18-month cycle, which we have probably seen already complete in October of last year, although there is a debate about the position of that 18-month cycle trough in October. We're not actually going to speak about that in today's video, because then we really will be here until the sun sets. So the point is that this is a very bullish cycle. I'm going to put a big plus sign there because it is an extremely bullish cycle. And then this cycle over here is a bearish cycle. How do we know that it is bearish? Because it experienced a very early peak. And of course, for the fact that it moved price down to a level lower than the level at which it started, at which the cycle started. So the question is that given that we had experienced a very bullish cycle, would we have been flabbergasted or surprised about the fact that the next cycle was bearish? I think flabbergasted is perhaps overstating it. We might have been a little bit surprised, but this is a really important point that I would like to make about these cycles, and this is really why I pulled out this question, because I think it's worthy of explaining this point. Cycles are things that influence financial markets. They influence them to move up and they move down again, and they leave a trail, if you like, in the price movement. In other words, they leave behind bullish cycle shapes and then bearish cycle shapes. As a general idea, we expect the progression of cycle shapes to move within a single 54-month cycle. And I should point out that over here, this is a 54-month cycle. At least it might even have been a 9-year cycle. So the progression within the 54-month cycle, because we have 3 18-month cycles. And I'd just like to point out, I'm not going to dwell too much on all the nitty-gritty details. Somebody posted a very sensible comment to the live stream on Monday that we do some Hurst Cycles basics, or you know, the basic ideas for those who are getting started. And I am definitely going to be doing that. Look out for that next week. I hope to do my first one. So in today's video, I might skimp a bit on the details, just in the interests of getting the information across as quickly as possible. But we have 3 18-month cycles within each 54-month cycle. And the first 18-month cycle is expected to be the most bullish because it is bouncing out of a big cycle trough. The second 18-month cycle is expected to be less bullish. Is it expected to be bearish? That depends on the longer cycles. Because if a longer cycle is turning down, then in fact the second 18-month cycle in a 54-month cycle might itself be bearish. Let me draw a very quick diagram over here of M shapes. Let me think about how I'm going to do this. So here is a bullish M shape. I hope you can see that. Yes, my screen is still there. There's a bullish M shape, late peak and higher trough. Now, if the much longer cycles have turned down, in other words, if this 9-year cycle trough was not here, but in fact lies ahead of us, then the 9-year cycle trough would be turning down, which would mean that we would then have a bearish underlying trend because of the fact that the 9-year cycle is pressing downwards. And so therefore, it is possible that the next 18-month cycle could indeed turn bearish. Have I drawn an M shape? Yes, there we go. Normally, when you have a 2-to-1 harmonic ratio, you expect a bullish cycle and then a bearish cycle. That is, of course, the definition of, or that is the way in which the M shape is created, because you first of all have a bullish cycle and then you have a bearish cycle. That gives us our M shape. And so our second 18-month cycle was expected to be less bullish and possibly even bearish. It turned out to be bearish. So was it a surprise? It was a bit of a surprise because of the fact that I was thinking that the 9-year cycle trough had formed in 2020. But here is the important point that I keep telling you I'm going to make. I'm now going to make it. Cycles influence financial markets, but financial markets are a bit like movies. I am a movie director. I don't know if you know that about me. My background is I'm a film and television director and writer. And there's a saying when it comes to films that you should always give the audience what they expect. In other words, if they're expecting a thriller, you need to give them a thrilling movie, clearly. But you need to do it in such a way that it comes as a surprise. So give the audience what they expect, but make it a surprise. And financial markets are exactly like that. Financial markets give us what we expect, but they always surprise us. And I think that's a really important point. I have a lot more to say about that, but I'm going to move on at this point. So the question, of course, is what is happening now? Because if we had a bullish cycle and then a bearish cycle, what would we expect now? And I hope that you are saying, well, that's obvious. We're expecting a more bearish cycle. And indeed we are. We're expecting a more bearish cycle. And you might have noticed that so far, this cycle is not necessarily more bearish. It's not certainly more bullish, but our expectation is certainly for a more bearish cycle. Which brings me to the final point about this question. This was a really great question. The final point about this question is that although we are expecting a more bearish 18-month cycle, it is quite possible that we will be surprised and that the next 18-month cycle will not be a lot more bearish. That would be the ideal scenario, but it is quite possible that this next 18-month cycle is going to turn out to be a fairly neutral cycle, or perhaps only as bearish as the previous cycle. So the important thing is that we develop an expectation on the basis of the cycles. And then as we track the unfolding cycle picture, we are monitoring that and we are looking out for divergence from what we expect. And then we might need to adjust our cycle analysis. So I hope that that answers that question. And I see other questions coming in the interest of keeping this as neat as possible. I am going to come back to those questions. I'm just going to move myself to the other side of the screen. There we go. That's a little bit easier. Okay, and let me do that there. No, in fact, I'm going to jump back and forth across the screen. There we go. Our next question. I am seeing questions come in, and I will do my best to get to them in the course of today's Q&A. I'm not going to make it too long. If we run out of time, I'm first going through the questions that have been emailed to us. If we run out of time, then I will be sure to answer your questions next time we do a Q&A. I'm hoping to do these every week. I can't promise that yet because of my schedule, but I am hoping to. Okay, so let's take a look. Let's zoom in to answer the next question. You're seeing the question. The 20-day FLD on the S&P 500 was not even touched this week. Where was the 20-day cycle trough? So that's a really interesting question as well, because of the fact that I've zoomed in here. We're still on the S&P 500. Let me zoom in again. Now, you know that I track a sequence of interactions between price and the FLD. I speak about it so many times that I'm sure you are a little tired of hearing me say it. So the sequence of interactions between price and the FLD, any FLD, not just the 20-day cycle FLD, any FLD is a regular sequence. And here is that regular sequence. When it comes to the 20-day FLD, which is this purple line, and I do have another question coming up asking in more detail about the FLD. So I'm going to be providing you with more information about the FLD fairly soon. So the first interaction between price and this FLD, I hope you can see that line. It isn't highlighted anymore, but here's the FLD. I'm drawing over it. And so the first interaction between price and that FLD, and of course, interactions are gauged on the basis of when median price crosses the FLD. So if I display median price, I can work out exactly the point at which price crossed that FLD. That is our first interaction between price and the FLD following the 80-day cycle trough or 20-week cycle trough that I believe formed on the 13th of March. So there is our first interaction, and that generated a target which I believe has just now been reached only this week. So that's our first interaction. We label that a category A interaction, and we expect price to come up and reach that target, which, as you can see, it did. The next interaction is labeled a B category interaction, although more and more nowadays I refer to it as a BC pair. The B category interaction is where price comes down and finds support at the level of the 20-day FLD. The C category interaction is when it bounces up again. Okay, we expect price to find support at the level of the FLD. Now, the important thing to remember here, the important thing to bear in mind, is that this interaction between price and the FLD is something that I discovered. It's not really a part of Hurst's original theory. I'm quite careful to always point that out. because Hurst never mentioned this whole idea of the way in which price interacted with the FLDs. He did mention calculating a target on the basis of it and so forth, but the sequence of interactions is a bit of an addendum, if you like, to Hurst's original theory. I think it's quite important to point that out. So here is the interesting part to this question. We are or were expecting a 20-day cycle trough to form. Here is the nest of lows for the 20-day cycle trough. You can see the circles with the lines to each side. We call those the circles and whiskers. They form a triangle standing on one of its points at the foot of your chart, and that is when we expect the 20-day cycle trough, pretty much right over there, which was only 3 or 4 days ago. So there are two things happening here. The one is that we're expecting a 20-day cycle trough to form. The other thing is that because of the interaction between price and the FLD, we are expecting price to find support at the level of the FLD. The question that was actually asked here is that because price didn't actually reach the FLD, you can see it didn't reach the FLD here, it didn't reach the FLD there, it in fact did find the FLD there and found support there. So the question is, where is that 20-day cycle where's that 20-day cycle trough? I beg your pardon. The 20-day cycle trough, in my opinion, is over here, right up above the nest of lows for that 20-day cycle trough. And if we measure the number of bars, you can see that that 20-day cycle trough occurred at 15 days since the 20-week cycle trough. The fact that price did not even touch the FLD does not negate the fact that the 20-day cycle trough has formed. Neither does the fact that the price came closer to the 20-day FLD over here on the 24th of March indicate that that is a better position for the 20-day cycle trough. The 20-day cycle trough, in my opinion, has formed here. What does it mean to us that price did not actually reach the FLD? So it didn't find support at the level of the FLD. Not only did it not find support, it didn't get to the FLD. Okay, it fell for one, and then it climbed for 3 days and then fell for another day. So what does that mean? That indicates that there is bullishness in this market. What happens when there is bullishness in the market? The one thing that happens is that price fails to reach the FLD when it is expected to find support at that FLD. So that's not unexpected. And the other thing that happens when there is bullishness in the market is that troughs occur early. The average length of a 20-day cycle trough is 17 days. That is a number that was discovered by Hurst 50 years ago. And I know I keep repeating that, but I find it extraordinary that even today, we still see 20-day cycle troughs that are very close to the average length of 17 days. This trough came in 2 days early, in my opinion, and so that makes it an early trough, a slightly early trough, indicating that there is still bullishness in this market. Do we expect bullishness at the 20-day cycle level? Yes, we do, because of the fact that this is a 20-week cycle trough. And a very easy way of counting the bullishness is you simply count the diamonds. So here is the 20-day cycle diamond. How many diamonds do we have above it? 1, 2, 3. So that gives us a bullish impetus of 3 cycles. 3 cycles are pushing upwards. Okay, so and I do see questions. There are people who've been joining us, and I see questions. I will get to them. I intend to at least respond to every question that you ask, even if I don't get to answer it in full. And a separate part of this question that I didn't put on the slide had to do with the fact that if you were waiting for price to find support at the level of the 20-day FLD, and you wanted to enter a trade at the level of the 20-day cycle trough, I shouldn't say at the level. If you want to enter a trade as price bounces out of the 20-day cycle trough, which of course it did on Wednesday of this week, how would you do that? One way of doing it is, of course, to wait for it to hit the FLD. But given that it's a bullish market, it might not hit that FLD. Another way of doing it that I know several traders actually use is they draw for themselves a trend line. So from this peak over here, they wait until a secondary peak forms. They extend that trend line downwards, and they effect their entry when price crosses that trend line. It's just an idea. You can take it or leave it. So let's move on to the next question, and then I'm going to respond to some of the comments that I'm seeing here. So we'll take a little bit of a break. We had an interesting question about the CML, the composite model line, and FLD projections, and about those FLD projections and the composite model line sometimes being at odds. I wonder if I can demonstrate this by showing you in the software. It's probably a little bit more of a conceptual idea, but let's just see if we can. Let's find some other FLDs here. There's an 80-day FLD. Good. I was rather hoping that might happen. Let's see if we have a 20-week. No, not really. Okay, so let's just focus on this 80-day FLD. So price crossed above this 80-day FLD, and I know that we should be looking at this FLD on a weekly chart, but in terms of answering this question, let me just consider it here on this chart. There is a tool in Sentient Trader called the Composite Model Line, and that I've spoken about many times before in previous videos. And so I'm not going to explain in too much detail what it is now, apart from mentioning that the composite model line is a result of recomposing all of the information derived from the analysis. So the software measures the wavelengths that, of course, have been found and the amplitudes of each and every cycle. It measures that information, of course, and recomposes it to produce the composite model line. So the question is, what happens if you have an FLD target that is going contradictory to the composite model line? And this is probably not really a very good indication. Apologies for that. I thought I'd put my phone on silent. I'm still learning about this live stream thing. So let me do that right now. There we go. So this actually, it really isn't in contradiction, but here we have a target generated as a result of price crossing the 80-day FLD, and that is projecting up to this sort of level over here. Now, the composite model line is projecting further. So this is not really in contradiction, but you will find sometimes the composite model line is actually projecting downwards, whereas an FLD target is projecting upwards, or the other way around. So the question is, which one should you give more weight to? And the answer is, there isn't an answer. These are two separate tools available in Sentient Trader for you to understand the analysis and to consider the analysis that you're seeing on your chart. Sometimes the composite model line proves to be extraordinarily accurate. In fact, charting cycles on Twitter, if you don't follow charting cycles, you must follow charting cycles on Twitter. He often posts examples of the composite model line proving itself months after the original projection. Sometimes it's extraordinarily accurate, but you must remember the composite model line is only another way of visualizing the analysis on your chart. And because of the principle of variation that Hurst discovered as part of his original theory, he discovered it 50 years ago, the principle of variation tells us that cycle wavelengths and cycle amplitudes are constantly varying. So there is an inherent flaw in the composite model line, which is based on the idea that the cycles will continue to beat with the same wavelengths and the same amplitudes. So if you have conflicting information from your FLDs and from your CMLs, my opinion would be to pay more attention to the FLD, because the FLD is more of a traditional tool. It's a simpler tool, and it is less prone to error. The composite model line is inherently slightly flawed. I hope that that answers that question. So let's quickly refer to some of the questions here. I'm only actually going to answer your questions if you're live. I've got many more comments. Thank you very much. We have somebody asking about nat gas and crude oil. I will certainly look at natural gas and crude oil. I'm not going to do it today because sitting watching me trying to open workspaces and figure out what data is a bit dull, but I'll be sure to cover that in a Q&A fairly soon, or in one of our other videos, perhaps one of our market update videos. And Adrian asks, why don't we do any Hurst cycles on TLT? There isn't really any particular reason why we don't do any Hurst cycles on TLT. It's simply something that I've never traded personally, and I mean, I don't really particularly watch it. So that's the answer to that, but we should certainly look at it. And so that will be interesting to take a look at those. at TLT, nat gas, and crude oil. And we've got some comments about nat gas and crude oil. So that's great. Thank you. And Bitcoin. We're going to take a very quick look at Bitcoin later because we have a question about Bitcoin. So I am going to do that. And we have a question about the, in fact, I can show you these questions. I forgot how to do that. Here we go. There we go. There's the question about nat gas and crude oil. Right, I will get to that. And Adrian about TLT. There we go. Mary, thank you very much. And Chris has a comment about nat gas down, crude up until it changes. Okay, which of course it will do at some point. Nat gas way oversupplied. And Hasta la Vista asking for Bitcoin. I'm going to be taking a quick look at Bitcoin later. Hang Seng Index, can I guide you to the steps? Yes, I will. Not in today's video because I do have some workspaces for Hang Seng, but I think that I will, in fact, do that in a future video. And Alexandra says, is there a demo version of the software to play with? Yes, there is. So contact us on support. Just send us an email, support@Sentient Trader, and we'd be very happy to help you with that. So let's go back to the questions that were emailed to us. I'm making good progress, so I think we're going to be able to keep this video fairly on time. There we go. So our next question was about gold and mining stocks. They've had a recent rise stronger than I expected. Is there a cycle due about now in gold, or has this further to run? So that is a really interesting question. And in the market update video that I did, I think it must have been last week, I spoke about gold, and I mentioned, in fact, exactly what I'm going to speak about today in answer to that question. So let me just switch screens. There we go. So now we can take a look at gold, and let me put myself over there. Okay. So here is gold. This is the gold analysis that I've been looking at. I've been watching and tracking for quite a long time, several months, I believe. And as I mentioned in the market update video that I recorded last week, Monday, I mentioned the fact that the 40-week cycle peak, I beg your pardon, in my opinion, probably formed over here. So I think that this question is about the fact that gold seemed to come into a 40-week cycle peak, and yet, and then of course it moved down, and we were saying, okay, it's falling down from a 40-week cycle peak, but it has recently bounced straight back up again. Of course, part of that bounce was fueled by the Silicon Valley Bank debacle, which provided a little bit of impetus to potentially distort price movements a little bit. But there's a really interesting conversation to have, and I apologize if this conversation is going to get a little complicated and a little advanced, because I'm going to present my ideas about what is happening and how I tend to work with Sentient Trader, which I hope will prove insightful and not confusing. I mentioned in the market update about gold that this 20-week cycle from peak to peak, and of course, there's a separate conversation to be had about whether we should be looking at a peak analysis or a trough analysis in gold. My opinion is that the peak analysis is usually more reliable, but the trough analysis can provide very useful information, as it does today, or in the analysis of gold. So here we had a 20-week cycle that ran for 155 days. The average length of a 20-week cycle is 136 days. The recent average wavelength of the peak analysis in gold, you can read at the top of your chart. You probably can't because the screen is probably really small, but it's something like 23.2 weeks, which is quite long. Okay, the 20-week cycle actually averages about 18 weeks, 136 days, and so 23 weeks is really long. So the 20-week cycle has been running long, and there are reasons for that, but let me not go into them now. So that makes a very good 20-week cycle trough, in my opinion. But there are other positions for that 20-week cycle trough. And if we measure the number of days from that peak to where Sentient Trader has positioned the 40-week cycle peak, which is over here, you can see that is 222 days. Now, that is very long. And in my opinion, it is too long. I really think that is stretching that 20-week cycle. So the interesting thing is that what Sentient Trader has done here is it has, of course, positioned the 40-week cycle peak at the most prominent peak. So now this is where I'm going to get a little bit complicated. Most people like to see a finished analysis that they are completely confident about on their charts. I'm going to show you how I work. I think that this 40-week cycle peak is better positioned over here. I'm not going to position it here. I could start pinning the analysis and influencing it, but I'm not going to do it now because I don't think that is necessary. In my opinion, the 40-week cycle peak is better positioned over there at 333 days, which would mean that we would have had 176 days for the second 20-week cycle in the peak analysis. So if we shift that 40-week cycle peak over, then how is that possible? If we shift the 40-week cycle peak over, then effectively all we are doing is we are transporting those three triangles that mark the position of the peaks over to this position over here. So what does that mean? That means that this peak over here is a 40-day cycle. Now, that is my interpretation of what is happening. And I posted a video about it 2 weeks ago, stating that was what I thought was happening, that 40-week cycle peak formed over there. I don't bother changing the analysis on my charts because it is also important to realize that this could be the 40-week cycle peak over here. So we have to entertain both ideas. And this is a complicated aspect of cycles analysis that I know frustrates many people. You have to keep in mind two possibilities. But I hope to demonstrate to you that there is a way of doing that that doesn't lead to confusion. So let me do my best. So what is happening here? In my opinion, what is happening is that the troughs have become dominant. In other words, the trough analysis has become really important. And we have, in my opinion, a 54-month cycle trough that occurred at the end of September. And I have discussed this in other videos. It's possible that it occurred in October or in November, but nevertheless, a 54-month cycle trough formed recently, and that the 20-week cycle trough formed very clearly over here at the end of February, or perhaps that was the beginning of March. Okay, so because of that, we have a tremendous amount of bullish pressure because the 54-month cycle is pushing upwards. The 18-month cycle is pushing upwards. The 40-week cycle is pretty much topping, okay? And so we have bullish pressure from longer cycles. So because of that bullish pressure, it is quite possible that what has actually happened in terms of the peak analysis is that price came up, formed the 40-week cycle peak over here, then came down into the 20-week cycle trough. And now what is it doing? It is now in its second 20-week cycle in terms of the trough analysis. And what it has formed over here, because I'm shifting those cycles off to the left, what it has formed over here is only a 40-day cycle peak. Only a 40-day cycle peak. So what does that mean? I hope this has not been too confusing. What it means is that in terms of the peaks, if this was a 40-day cycle that has elapsed, then we have a tremendous amount of bullish pressure. Can you see that? Because that 40-day cycle, following a 40-week cycle peak, managed to bring price to a new high. We have started a bullish W shape. Peaks form W shapes in markets, and therefore we would expect more bullishness. So how can we make sense out of all of this? We will zoom in, and given the fact that we are expecting more bullishness, I drew very roughly this line over here with the move down, and then we are expecting another move up. The useful tool to use in Sentient Trader at this point is, in my opinion, the zigzag. The zigzags provide us with useful information in terms of where these cycles are projecting. Now, you'll notice these zigzags are based on this analysis. And so if the 40-week cycle peak has only occurred recently, then we are expecting the general moment or momentum of these cycles to bring us down into this trough over here in July. However, here is an 80-day cycle trough in May, and there is my consideration. And if we take a look at the zigzag for the 40-day, let's take a look at the zigzags for the 40-day. And there we go. There is the 40-day cycle zigzag, and that 40-day cycle zigzag is, or of course, indicating moving down into this 40-day cycle trough over here, but it will provide us with, in my opinion, a less bearish implication in terms of what is going to happen. And so we will be watching as price comes down into the 40-day cycle trough. Then we would expect an 80-day cycle trough, and that is then going to be critical, because if it breaks up and pulls up to new highs, then I am correct about this being a peak of the 40-week cycle and this only being a peak of the 40-day cycle. However, if price, having formed this 80-day cycle trough, which it must do in both scenarios, it must form an 80-day cycle trough. If it struggles to break up to new highs and instead comes down again, then the 40-week cycle peak is over here. I hope that makes some sense. Got a little complicated, didn't it? But I do hope that makes some sense in terms of answering that question. So let's take a look at our next question. And right, so now we're going to go to Bitcoin. Somebody asked a question about Bitcoin. Somebody pointed out that their zigzags on Bitcoin are red for the 20-week cycle. What does that mean? So this is something that has to do with Sentient Trader particularly, but it gives me an opportunity to speak about Bitcoin. And I know that we've had several requests for Bitcoin. So let's take a very quick look at Bitcoin. And there we go. Here is Bitcoin. This is the analysis we've been looking at for some time. I mentioned in the live stream on Monday, the market update live stream, the fact that I believe the 80-day cycle trough occurred over here in the middle of January. My reason for that is because of the FTX news events, which in my opinion pulled the market down very strongly. And then we had more news-related price movement over here, providing us with a really rather oddly shaped sort of a bowl that is sort of a shallow bowl that formed in Bitcoin. And the 80-day cycle trough, in my opinion, is well positioned over there, indicating that this here is either a trough of the first 40-day cycle, or more likely it is the 20-week cycle trough that came in over there. As a matter of interest, on Monday, I pointed out the fact that Bitcoin needed to come down to the 20-day cycle FLD. Let's hide the 40-day cycle FLD for now. And there is the 20-day cycle FLD. And if you take a look at the market update live stream from Monday, you will see that I was speaking about price finding support at the level of that 20-day FLD. And this is exactly what has happened so far. And why does it find support there? Well, because there is where we are expecting the 20-day cycle trough. And so that's a very likely position for the 20-day cycle trough. Here is our analysis. I'm expecting that to be a 20-week cycle trough that formed over there. Here is our first crossing point. That's an A category interaction, which of course reached its target and exceeded it, and then price comes down and finds support at the level of the 20-day FLD in a B category interaction. The C category interaction, which makes up the second part of that pair of interactions, is as price bounces upwards. Now, here's the interesting thing, as I pointed out in the recent market update videos, we have the 40-day cycle peak over here. And so what is forming now is almost certainly a peak of at least 40-day magnitude. However, look at this circle for the 18-month cycle. It is absolutely possible that the 18-month cycle is going to form a peak here. How will we know? We don't just sit there and wait until the 18-month cycle triangle appears at the top of your chart. We are going to be watching our interactions with the FLDs, the 40-day, the 20-day, and all of the FLDs that we have available to us. Let's just display this 40-day FLD over here. And so, of course, the next interaction with the 20-day FLD is that price is going to form a peak, which it might have done already, or it might still lie ahead of us, and then it's going to come down, it's going to cross below the 20-day FLD. However, we are expecting price to find support at the level of the 40-day FLD. And so the pattern continues. And at some point, if the 18-month cycle peak has indeed formed, price is going to stop finding support at the level of these FLDs and instead cross down below them and generate targets to the downside as price moves down. So to get back to the original question, which actually had to do with the zigzags, I presented zigzags a moment ago on the other chart. Here are the zigzags that this particular question referred to. Now, you can see these zigzags are colored red. And the reason for that is because they are, in fact, invalid zigzags. Let me see if I can find some valid ones. There we go. These 40-day cycle zigzags are completely valid. The way that the zigzag tool works is you can only use it when you have a peak analysis at the top of your chart and a trough analysis at the foot of your chart, which is called a dual analysis. So we have two analyses on this chart. They are not one analysis, they are two separate analyses. And the way in which the zigzag tool works is it makes the assumption that price moves from a peak of the cycle in question, the 40-day cycle, down to a trough of the 40-day cycle. And then it moves up to a peak of the 40-day cycle, and then it moves down to a trough of the 40-day cycle, and so forth, all the way through the price action. Now, when there is some kind of disconnection in your analysis, you will end up with red-colored zigzags. And here you can see them in the 40-week cycle. That means there might be an error in this analysis. It's an indication that there's some kind of anomaly in this analysis. It's a warning. And in particular, you can see that this over here has been phased as a peak of the 20-week cycle. We would expect price to move down from the peak of the 20-week cycle into the next 20-week cycle. Here is the next 20-week cycle. Price has not moved down into that peak, clearly. Okay, it has in fact been moving upwards. And that is why we get these red lines over here, because of the fact that that is an invalid zigzag. Now, why is that zigzag invalid? In my opinion, it is because the news events, the FTX news event, caused the price of Bitcoin to move more dramatically to the downside than would have been expected. And if price had not moved so dramatically to the downside, if price had just continued without being affected by the news events, then it is possible that this trough would have occurred at about the same time, but perhaps at a higher level. The 20-week cycle trough, in my opinion, actually formed over here. And so it is quite possible that the orthodox, one might say, the orthodox price level at which that very big cycle trough should have formed, if it hadn't been for news events stretching price a little bit to the downside, maybe it should have been at a slightly higher level, in which case this zigzag would probably not be red in color, and we wouldn't have the anomaly in our analysis. So I hope that that answers that question and provides you with a glimpse of Bitcoin. Our final question, right? Our final question is in Italian. I live in Italy, of course, and not many of you know this, apart from our Italian customers, but we do provide support in Italian. So I'll translate that question for you. This person is asking whether it is possible to perform an analysis with only one cycle, not perform an analysis, but to work with only one cycle. And of course, it is not possible to perform an analysis using a nominal model which consists of only one cycle, because the analysis process requires a nominal model that has a large number of cycles. In fact, it is 11 cycles that have to be a part of that nominal model. But it is absolutely possible in Sentient Trader to work with only one cycle. And so I'm going to very quickly demonstrate to you how you can do that. There is a tool in Sentient Trader called Cycle Lines. And we can study the cycles of individual cycles over here, such as this one over here. This is the 80-day cycle. And we can look at, for instance, the 80-day and the 40-day cycle. So we can separate those cycles out. And when we zoom in, we can see what those cycles are doing. You can see the cycles are shaped like sine curves, sine waves. They're not perfect sine waves because of the fact that the wavelengths are varying and the amplitudes are varying. And because of that, they are slightly twisted. But they provide the raw cycle information, if you like. The other thing that you can use when you're displaying your composite model line is you can display individual cycles. So we could, for instance, cut out all of these longer cycles in our composite model line, and we could consider the composite model line that consists of only one cycle. Then we can start adding these cycles together. What is the influence of the 80-day and the 40-day? What about the 80-day and the 20-week and the 40-day? By combining only those three cycles, we get a fairly good representation of what has been happening in the market in terms of those individual cycles. Now, I am planning to wrap up this Q&A fairly soon, but we did have a very interesting question about oil. So let me quickly show this to you. We had a question earlier about performing an analysis of oil. I'm not going to perform an analysis of oil, but I thought this was a very interesting question because it was a question sent to us by a fairly new user of Sentient Trader. And what they have done, they have sent us two separate analyses of oil. This one up at the top, this top analysis is an analysis performed over a fairly long period of time, going back to 2008, coming up all the way to today or this week. And this second analysis, you will notice the grayed out data over here, has been performed over a shorter period of time. This is something that I definitely encourage people to do because it is not always a better idea to look at more data. And this is a prime example of that. By looking at too much data, sometimes the software is too heavily influenced by what happened 12, 13, 15, or 30 years ago. And you don't really want that. You want the software, or you want your trading to be more informed about what has been happening recently. So on the surface of it, this analysis at the top doesn't really have anything wrong with it. A few pointers if you're working with Sentient Trader. First of all, don't display every tool. I know the software comes in the package with all the tools displayed for you so you can see them on your chart. Otherwise, people ask us, where are all those tools? Because there's nothing on our chart except the bars. So the first thing I like to do is strip things away. In particular, I would strip away the composite model line. The composite model line is serving no benefit to us over here. And because we have a limited analysis with a limited lookback period on some of the cycles, you'll see the composite model line gets extremely frenetic over here with all the shorter cycles. There is really no point in watching 5-day cycles on a chart that shows 13 years worth of data. So I would hide the composite model line. That's the first thing I would say. The next thing that's really important on any analysis, whether you're performing the analysis yourself by hand or whether you're getting Sentient Trader to perform the analysis, is to question that analysis. The first thing that occurs to me when looking at this analysis, and the first thing you need to do when questioning an analysis, is look at your longer cycle trough. So here we have a 9-year cycle trough in October or November, I think November of 2008. Is that a sensible trough in price? Yes, it is. Where's our next 9-year cycle trough? It's over here. Is that a sensible trough in price? Now, you might think so, because yes, there's a trough there. But look at this cycle shape. And we're getting back to the cycle shapes of the 18-month cycles. There's the first 18-month cycle following this 54-month cycle. Here is the second 18-month cycle, a very bullish, very bearish one, beg your pardon. And then we had a bullish 18-month cycle. Can you see how that sequence is wrong? This is a bullish cycle, which is what we expect. This is a bearish cycle, not impossible. And then this again is a bullish cycle. That is a problem. The more likely position for this 9-year cycle trough is over here. If you want to analyze this much data in Sentient Trader, you're going to have to influence this analysis. You're going to have to pin it. There are various ways of influencing the analysis. We're not going to go into it now. But that is a problem. And that same problem is repeated over here. Because here we have a 9-year cycle trough, and here is the next 9-year cycle trough. Let's look at our cycle shapes here. We had a bullish 18-month cycle, Good. We expect a bullish 18-month cycle. Then we had a very bearish 18-month cycle. In fact, the price of oil went negative, if I'm not wrong, in about 2020. And so we had a bearish 18-month cycle, but bullish, bearish, and then we had a very bullish 18-month cycle. Again, the sequence is wrong. In a 54-month cycle, it should be bullish, even less bullish, or bullish, neutral, bearish. Okay? It should not be bullish, bearish, bullish. That means there's something wrong in the analysis. And what is probably wrong has been correctly determined in this analysis using less data. Here is the 54-month cycle trough over here. Here is the first 18-month cycle, which is bullish. Here is the next 18-month cycle, which I'm going to call neutral. Can you see? It's a very neutral cycle. Peak in the middle, trough, two troughs at about the same level, very roughly. And then here is a bearish 18-month cycle. So you had bullish, neutral, bearish. Perfect. Hurst cycles analysis is actually really simple. That's all you're doing, is you're identifying the shapes. You get a bullish, neutral, then bearish sequence. That's really all it involves. Some of the details, of course, are a little more complicated. So there was another picture that was sent to us, and that provides us with a zoomed-in view of these two analyses. So again, we have the same two analyses, the longer term data at the top and the shorter term data at the bottom. And the question here was, which one of these is correct, because they're saying different things. This one is expecting an 18-month cycle trough over here in about the third week of April. First of all, I would hide this composite model line. It's not contributing towards your understanding of the cycle picture. Use the tools to help clarify and simplify things. We also have a bunch of trading suggestions over here on the right-hand edge. So, all that kind of thing, I would recommend you hide until you've come to grips with the analysis. The other analysis here at the bottom of the chart has the 18-month cycle trough having already occurred. So how do we question this? Well, it's a little difficult to question it by only looking at a zoomed in part of the chart. But considering our consideration of the longer term view going back to 2008, I think that the lower analysis is probably the better analysis. It's really important to question that analysis. So here we have a 20-week cycle trough. Here we have an 80-day cycle trough. And here we have an 18-month cycle trough. Let's look at those cycle shapes. There is a fairly neutral 80-day cycle trough, and here is a more bearish 80-day cycle trough. So I would call that neutral and then bearish. But if we take a look at this analysis, we have a bearish 80-day cycle trough and then another bearish 80-day cycle trough. It doesn't pose an anomaly of any kind, but we have a bearish 20-week cycle. And then over here, we have what is turning into another bearish 20-week cycle. So in this case, bearish and bearish. So in this case, there aren't any obvious anomalies. So how do we decide what is actually correct? The way in which I decide, and everybody might have their own approach, the way in which I decide is always to zoom out and decide how confident I am in this analysis. And unfortunately, we can't do that in today's discussion because we can't see any further. How confident am I in that 40-week cycle trough? Is that a better 40-week cycle trough than this trough over here? And you need to compare them. The only difference between these two analyses is that we have cycles that have been shifted to the left. Can you see that at the 80-day cycle level? That's this cyan colored cycle over here. At the 80-day cycle level, there is no difference in the analysis. So off the top of my head, I would say that my confidence in this analysis is at an 80-day cycle level. I would like to develop a higher confidence, but at the moment I'm fairly confident in the 80-day cycle. If I see price crossing a 20-day cycle FLD, I would be interested potentially in entering into a sequence of trades on the basis of the 20-day cycle FLD, because I have confidence in the 80-day cycle on both of these analyses. So I hope that answers that question. And we have a few questions that I'm going to very quickly I don't have any slides for this, so I'm just going to go full screen. Here we go. And let me just pull this down. Very few questions that came in too late for me to create slides for. How do I set up and use Growl alerts? Growl is actually a pretty old-fashioned system for sending alerts to your mobile phone or to email, and Sentient Trader will do that for you automatically. I would recommend you get in touch with support. They will help you do that. It's really very easy to set up. The 160-minute VTL does not appear on the chart. How do I make it appear? So there's an interesting, very quick discussion to be had there about the VTL. And let me just see if I can present Sentient Trader to you again. Sentient Trader presents VTLs. Where are we? I need to, there we go. That's what I need to do. An interesting question from Mike. I'll get to that in a moment, Mike. So let's speak about VTLs. VTLs are valid trend lines. So they are lines that obey certain rules. So if we display them, you can see I can display a whole bunch of VTLs. There we go. Okay. So you'll notice here's an 80-day VTL. There's no downward pointing VTL. Why? Because there isn't a valid one. A valid 80-day VTL would connect two peaks of the 80-day cycle, which of course need to be in a sequence of higher and then lower peak. Okay. So Sentient Trader will only plot a VTL if it can find a valid one. If there isn't a valid VTL that obeys the rules according to Hurst's guidelines, then it won't plot it. So if Sentient Trader is not plotting the VTL, then I would encourage you to understand why. It's because there is no valid VTL available. Okay, so I hope that answers that question. We have another question about FLDs. So let me quickly display an FLD. And let me display my favorite FLD, the 20-day, and zoom in. And I need to show you my screen. How do I do that? There. Okay. Is that right? Oh, yeah, except I've disappeared. Let me quickly, there we go. Okay, so let's take a look at these FLDs. I speak a lot about FLDs. What is the FLD? The FLD is a very, very, very simple line. It is simply the median price. The median price is the mid price between high and low of every bar. There is the median price plotted as an orange line on my chart. The FLD is very simply that median line displaced to the right by half of the cycle wavelength plus 1. So the trick, of course, is that you need to know what the current cycle wavelength is. We can never know what the current cycle wavelength is. That's the bad news, but we can estimate it. And if you have performed an analysis, either by hand or if in Sentient Trader you've performed an analysis, you can read your recent wavelength for each and every cycle out of the the right-hand foot of the chart. That's the recent average wavelength. And so in that way, you can know what the recent wavelength is. And you displace the median price by half of the wavelength plus, interestingly, 1 bar. And there are various reasons why the 1 bar. I won't go into them here. So that is what the FLD is. It's very simply a line. Hurst pointed out various features of the FLD in terms of it providing us with cycle information. I don't have time in today's video to go through them all. We do have videos about the FLD, and in fact, I'll ask our support to send you an email with links to those videos about the FLD and how it works and so on. The sequence of interactions that I speak about often is simply something that I invented, something I noticed when I was trading. Sometimes price crosses an FLD and produces a very profitable trade. Other times price doesn't cross an FLD but finds support and resistance. In my early days of trading with Hurst cycles, I tried trading every single FLD interaction and it didn't go very well. Let's put it like that. So I hope that answers that question. Then we have one more question, which was emailed too late for me to do a slide or anything, asking about the compounding of short-term trades. Yes, so the idea is that if you're trading a shorter cycle and you're making more trades more frequently than simply buying and holding, then you can make more money than if you were simply buying and holding. Assuming, of course, that you're getting your cycle analysis right and your trades correct. Is there a tool in Sentient Trader that will enable you to understand this? Yes, I'm still showing Sentient Trader, I think. We have a thing called Portfolio Manager, which is a part of the Trader edition of Sentient Trader. You can create portfolios of multiple instruments, and you can understand the trading that has been done on them if you build a trading history. Big subject. I cannot answer it in today's video, but the simple answer is yes, there is a way of understanding how your trades might have performed. You would first of all need to build a trading history. Okay, so that brings us to an end of what I was planning to speak about in today's video. And so here, catching up with comments, let's see. Let me see if I've got that in the right screen. Yes. Mary, am I surprised by gold strength? I'm not very surprised by gold strength for two reasons. One, I believe a 54-month cycle trough formed at the end of last year. Following a 54-month cycle trough, I'm expecting strength. Gold and Bitcoin, both of them. I think they're bullish. Of course, the peak analysis is important, but that 54-month cycle trough is going to give us some bullishness. So I'm not very surprised by it. The other reason, I mentioned there were two reasons. The other reason is because of the Silicon Valley Bank news event, which causes fear amongst people, obviously, who have their money in banks, and they're looking for a safer haven. Gold is traditionally known as a safe haven. Don't know whether it is or not, but that's another reason why gold could potentially be stronger than might even be expected as a result of the cycle analysis. Hardik says, if I can provide an update on QQQ, that'd be great. Yes, okay. I do have a big list of updates that I need to perform, but I will do. Some guy says hello, and Sagar do an analysis of the Nifty 50. Yes, the Nifty 50 is indeed requested. Marcel saying hello Marcel, and Tommy saying thank you very much. Mike says, why not include more than 3 cycles to average into the composite cycle? That's a really interesting question. And let me just move this out and show you my screen one more time, because first of all, it's a misunderstanding that I'm only choosing 3 cycles. I just happened to choose 3 cycles when I was chatting earlier. In fact, by default in Sentient Trader, when you turn on the composite model line, it includes every single cycle all the way down to the 5-day cycle level. I'll show you what that looks like. It's ridiculous, including Sigma L and everything. So the composite model line takes information from the cycle analysis. The important thing about the composite model line as a tool is you obviously need to make it work for you, to show you the information that you think is going to help you to make trading decisions. And so showing all the cycles often doesn't really help, because in the analysis, the calculation of the wavelengths and the amplitudes of various cycles can tend to cancel each other out, particularly if you have both a peak and a trough analysis, which I do here, but I'm not including the peaks in my composite model line. So the first thing I always do is I eliminate the shorter cycles so that we're seeing something that really works here. Then the next interesting thing about the composite model line is you will notice there are periods of time where price diverges from the composite model line. In particular, over here, price was not expected to come down very much and then was expected to move up. So price moved down. So you have some divergence. I like to understand why there is that divergence and what cycle contributed to that divergence. In other words, what cycle isn't really being reflected very well in the price action. I mention always that cycles influence price movements, and that that it's not an absolute science. The cycles, it's not a perfect science. They influence the cycles to move in a certain way, and sometimes cycles just seem to be squashed out of existence. And in this particular case, the 20-week cycle, in my opinion, caused that problem. Can you see if I eliminate the 20-week cycle from the composite model line, I end up with a composite model line that matches the price action a little bit better. Perhaps you would argue that it doesn't really, because of the fact that we didn't get quite such a good peak over here. But certainly, in terms of the structure of the move, we had a sort of a range-bound move in the composite model line and a similar range-bound move in price and so forth. So by eliminating a cycle, I find it often helps to provide us with better and clearer information. The idea that you've got to be absolutely focusing on every single cycle all the time, desperately obsessing about every cycle when you make your trading decisions is, in my opinion, a mistake. I like to sometimes sometimes concentrate on only one or two cycles. I think it's probably time for me to bring this to an end. I'm confusing my words, but that, I hope, answers that question. Okay, so next question, Marcel. Is there an indicator in TradingView that plots FLDs? Interesting question. In fact, we are building one that plots FLDs correctly. It includes gaps over the weekends and does all that kind of thing. I'm probably not meant to be mentioning this because it's not available yet. I'm going to be told off. But anyway, we are. I'm aware there are some other indicators, I believe, that will displace median price for you. That's all an FLD is. But it won't include things like weekends and gaps and stuff like that, which is quite an important thing. And hello, Thomas. You mentioned a lot price breaking through the FLDs, generating a target. If it is generating a target, does that mean it must happen in 20 days? So that's a great question, Thomas. The answer is yes. Well, no, it doesn't have to happen in 20 days, but it is expected to happen in 20 days. And I think we have an example that I can actually show you right here. Just very quickly, where were we looking at the... here we go. Okay, so if we show the 20-day FLD, here we go, on the S&P 500. I mentioned already when showing you this FLD that price crossed above the FLD over here, right? And it therefore generated a target. Now that target, if we calculate it, is somewhere over here. In fact, perhaps it hasn't been reached. I'm not going to bother calculating it now, but it is above this peak. That's the important thing. So in answer to your question, we expect price to achieve the target within that 20-day cycle. And if you're trading the FLD trading strategy, you will know that if price achieves that A category target within the first 20 days, that gives you extra confidence in the bullishness of the market. If it fails to reach that target, that's the first warning sign that it might not be as bullish as you expected. However, you do often see, here is the 20-day cycle trough, in my opinion, and here I believe this target has been reached. I might be wrong, might not have quite been reached, but certainly we've reached up closer to it. And so that is a target that has been reached or fulfilled in the next 20-day cycle. So I hope that answers your question. It's not a rule. It's not a matter of it must happen in 20 days. That's not how this works. We expect it to happen within that 20-day cycle, but sometimes it will happen later. And in Sentient Trader, you will perhaps know that Sentient Trader will monitor FLD targets generated in previous cycles because they often get satisfied later. Okay, so right, where do we go? And I'm going to have to bring things to an end fairly soon, but very quickly, for taking a trade, is it best to use the FLD? Can you explain shortly the trigger in case of a 10-day FLD? All right. Yes, seeing as I have this up here, I'll do my best to explain a trigger in terms of the 10-day FLD. And so let's see. Here we go, and there. Okay, and so here is a 10-day FLD. So the trigger is a little complicated, so I'm not actually going to explain the trigger. Sorry about that, but I can explain the sequence to you. So here is the sequence of the 10-day FLD. Let me see if I can get the software to keep that highlighted. Okay, here is a trough of at least 40-day magnitude. And I'm not even showing you my software. What did I do wrong? There we go. Add to stream. There we go. Okay, you should now be seeing that. Okay, so there is the 10-day FLD on the S&P 500. So this is a current example, if you like. Following a trough of at least 40-day magnitude, the first time at which price crosses the FLD is the A category interaction. If you were a very aggressive trader and a very confident trader in your analysis, then you might have entered into a trade, perhaps not at the level of the FLD, but possibly at the level of a previous high. Okay, so you might potentially have done that. I don't do that. I'm not that aggressive a trader. I wait until the first 10-day FLD, first 10-day cycle trough. Sorry, I'm getting a little tired. We've been going over an hour. So here's the first 10-day cycle trough. What do we expect at the first 10-day cycle trough? We expect price to find support at the level of the 10-day FLD. There are aggressive traders, I know, because I've worked with them, who will set a limit entry at the level of that FLD or any FLD. Mostly they do that kind of thing on intraday charts, 5-hour FLD, 1-day FLD, perhaps. You will, in other words, trade price that little, expecting, of course, the FLD to provide support. If the FLD does not provide support, you would exit your trade at a loss. But of course, in this case, it did, because we were correct about our analysis, and that being the 20-week cycle trough. And so therefore, that could have been your trade entry at the level of that FLD. If you are not quite that aggressive, then you might, in fact, only enter at the high of the bar at which it finds. In other words, you would have entered your 10-day cycle trade FLD somewhere over there. And of course, how long you stay in that trade is subject that will take several hours to explain. So that answers that question. And on that note, I am going to bring this one in. Thank you very much for joining me, everybody. Thanks, everybody. It's great to see faces and names that I recognize. I do hope that you have found this and I hope that you have found it interesting. And thank you very much for joining me, and I look forward to seeing you in future Q&As and live streams, market updates.